We're Sandstorm Gold. We are a royalty and streaming company. And we represent, I think, a different type of investment. I think we're unique amongst the companies that are presenting here today at the conference. We represent something that I think applies a better risk-adjusted reward for the gold industry and for the mining industry as a whole. The company itself was started in 2009 by myself and Nolan Watson. Like Eric said, for us, we originally came from Silver Wheaton. And Silver Wheaton is a company based out of Vancouver that really originated the whole streaming model in the industry. In 2009, we began Sandstorm. Nolan has more of a finance background. He is a CFA and a chartered accountant. And he's won all sorts of different awards. He's also part of the Young Global Leaders Group as well. I'm a geologist. We also have on the top here a couple of our other finance people and corporate development people. But I think what's important to note is that bottom line of our technical team. What's, I think, a key item in terms of the type of investments that Sandstorm makes to create its company is to make sure you're investing in the adequate and the proper risk-adjusted investments in the industry. So you need to have a very complete and a very thorough due diligence team. So some of these gentlemen here, the first two there, Tom Brewington and Keith Laskowski, they've been with us now for about 3 years. Prior to that, they were the due diligence team for the IFC and the World Bank based out of Washington, D.C., making their investments in the industry. If you don't know, streaming and a royalty company, just very briefly, is what we do is we give upfront payments in exchange for a percentage of the future revenue or the product that's produced at the assets. What that essentially means is that once you make your investment, you're not beholden to any of the further capital that needs to go into the asset. And essentially what you do is you take a top line of the revenue, which makes and creates for you something that gives the investor or your underlying investor a much clearer viewpoint as to where the free cash flow lies in the company. Here's a few facts about Sandstorm as a company. We have 133 streams and royalties. Of those 133 assets, 21 of them are cash flowing today. We hold no debt. In fact, we have a cash balance today. And by 2019, we will be producing a gold equivalent of about 65,000 ounces. And our overall cost, our total cost for those ounces is approximately $250 per ounce. And so the difference between the commodity price at that time and the 250 is essentially the operating cash flow after tax that comes towards us. This is illustrating the distribution of our royalties around the world. As you can see with those numbers in the top right-hand corner, the bulk of our revenue comes from North America, South America, with actually Canada being the primary area that we receive our cash flow from today. Now that we're a relatively well geographically diverse company, we feel that we are in that position, though, that our cash flow is strong enough and diversified enough that we can start taking a look at jurisdictions that potentially have higher political risk associated with them, as long as we can get an asset that has a lower technical risk associated. So we do find ourselves in that position to be able to take a little bit further risks with a small portion of our capital going forward. This, to me, is a very important slide and something that a lot of people don't realize how Sandstorm has changed over the years. This is our operating cash flow after tax. Each one of these columns represents our estimated cash flow for the subsequent years going out to 2021. There's a lot of things I want to talk about, but the first point I want to make is that this entire growth profile that you see here, the growth from about $45 million in cash flow today up to the $68 million of cash flow in 2021, we don't need to put in any further capital, any kind of investment, any of these assets to realize that growth. These are already projects and mines that are built and constructed as well. We don't require any of these assets to be built to receive this cash flow. So we are really very unique amongst the mining industry to be able to realize a significant cash flow growth without any other capital outlay going out the door, which means if this projected cash flow is achieved, that's something that goes directly back into the company and can be and gets right back into the pockets of the shareholders. What's also important to note about this cash flow is each one of these columns is broken down into those individual lines. Those individual lines represent different royalties or streams that are cash flowing. All of those assets that are in there have survived a $1,050 gold price. So we do have a good, strong base of cash flowing assets, which provides further security to our investors and to us as an investment. Now, drawing your attention to the pie chart that's in the middle of the screen, what we're trying to illustrate there is we're trying to illustrate the blend of commodities. Today, we have 85% of our revenue coming from either precious metals or diamonds. The one royalty that we have from diamonds is from the Diavik mine operated by Rio Tinto in the Northwest Territories. But of that 75%, other than that, the blend is mostly in gold. For us, we do see ourselves as a precious metals company. All the acquisitions that we see from this point onwards, we see as precious metals acquisitions. We have received some base metals in the past, but really as a byproduct to complete some transactions which are focused really on those precious metals. This next slide is a little bit of a continuation of the previous one. What we're trying to articulate in this one is that not only do we have a good solid cash flow base, but we still are able to capture that critical optionality that is very important to illustrate to shareholders in the industry. What we've done is we've taken that last column from the previous chart for 2021 cash flow of $68 million. That represents our current assets that are producing and what's coming online in our growth profile. What we wanted to illustrate with this is that assuming a higher commodity price by 2021, assuming $1,600 gold instead of $1,300, $23 silver instead of $18, and a $3 copper instead of $2.10, you would realize in that first, let me see if this works. Oops, sorry, that didn't work. You would realize in that first gray column, the 19 million, that's the additional higher cash flow that we would receive. So on top of the 68, we would receive 19 million more in additional cash flow just on those existing assets. That second gray bar, what that represents is it represents the optionality that we have. So existing royalties, existing streams that we have, in a higher gold price, we picked 4 of those that are really ready for entering that construction period but are waiting for higher commodity prices. If those 4 royalties and streams came into place and those assets were built by 2021, that's the additional cash flow that you would see fall into that profile. And that's without any additional investment from us. So seeing a rising commodity price environment, you would see our cash flow go from that $68 million to something that's closer to $108 million, which is a substantial jump, especially considering, again, no further investments would need to be made by us. And when you take us and you compare us to the other royalty and streaming companies that exist, none of the other companies have that type of profile. In fact, none of the other royalty and streaming companies have this type of growth profile without seeing construction of a bunch of assets already in their profile. So we're really unique amongst our peers. Another thing I think that's important to point out is how we've transformed ourselves over the years. I think when Sandstorm emerged, we were considered the streaming company of the junior mining industry. We had a lot of transactions with junior companies, but that's changed, especially over the last 3 years. In 2013, we saw 88% of our revenue coming from junior companies. Today, we've improved our counterparty risk by a number of ways, and now we're seeing close to 80% of our revenue coming from either mid-caps or senior companies. By 2019, we expect that to go up to close to 90%. Now, the reason that's happened is because we have been actively deploying capital with a lower counterparty risk. But what's also happened is that we've made those good investment decisions earlier on in the genesis of the company. And many of those investments that we've made have been swept up and brought in to larger companies. And now we have a base of companies that are producing for us, like Glencore, like Newmont, like Yamana, as opposed to the Brigus Golds and the Lunas of the past for us. So our cash flow is important, and understanding that good, strong cash flow base has been important for us to establish and to grow the company as. But I think what's important to know for us is the unrecognized value and the optionality in this industry that we're exposed to, that I think a lot of the market still does not understand yet. The interesting thing about this industry is that at points like what we've seen in the last 2 to 3 years, the market and investors refuse to give any kind of value to optionality. But at other parts, as you get into a rising price environment and as you get to the top environment, optionality is given almost unlimited value by the market. And so what I'm going to try to do in these next several slides is illustrate how that unrecognized value still resides within Sandstorm. This first slide is really just pointing to the success of the investments that we've made so far. The first column, that's labeled 47 to 50,000 ounces, that represents our production guidance for this year. The second column illustrates in the first 3 quarters of 2016 the ounces that have been discovered attributable to Sandstorm through their streams of royalties on our assets. 84,000 ounces altogether, 63,000 ounces in the assets that are producing. So in that expected production of 47,000 to 50,000 ounces, already in the first 3 quarters, we've more than replaced the reserves in those existing assets. Again, without us having to put out any capital for that exploration. The next thing I'd like to identify is really the development stage projects. We have 9 projects that we have royalties or streams on that are not in that previous cash flow forecast. These are assets that are well levered to the gold price, and in a higher commodity price environment, we could see these assets come online. And those assets represent 1.2 million ounces of gold equivalent resources attributable to us, and more cash flow on top of that, which I'll speak to in a few moments. The last thing is that taking aside those 21 cash flowing assets, a few of those development assets on top of that, we have another of these 90 exploration stage royalties. So these royalties are busy moving up the stage. Many of them have had a tremendous amount of money raised exclusively for their exploration. And as we go through this cycle, we certainly expect, not all of them, but a great deal of them to move up that stage from grassroots exploration to resource development and into feasibility type of studies. So that represents something that can add value in the future and growth in the future as well. And something that's very, very subtle, and I think a lot of people don't realize at all, is what we've been doing in the last several years is purchasing rights of first refusals and royalty buybacks. So in addition to the 133 royalties, we've done transactions with many Canadian companies where we've obtained their rights to buy back portions of the royalties. These are real, true options to be able to, for a fixed, already predetermined price, buy royalties up to 1% once we realize that there actually is some distinct value behind them and these assets are going to get into production. This is a slide which is trying to illustrate the transactions that we've done over the last 2 years. The reason we bring it up, because it is very indicative of, I think, the plan that we have in the future going forward for our acquisition strategy. You see some of these acquisitions like the Karma Stream for $30 million, the Diavik royalty for $52 million, the Yamana royalty for $152 million. These are really the core of where the bulk of our capital is deployed, in these good, solid, consistent cash flowing producers. However, beyond that, but the greater number of transactions have been on the higher optionality assets and packages of royalties. These ROFRs, some of these royalties, like the Alto Paraná royalty, we were able to roll in that asset into our company and roll it out to a purchaser for actually a net payment to us of $200,000, but we also retained a royalty going forward. The management team that we have is very creative. We work with a number of different venture capital groups in the mining industry based out of Vancouver. And so we see a tremendous amount of deal flow of all stage of types of projects in there. Anytime we see something that we feel has got good value to it, or if it's a high quality asset, we try to come up with a good creative way to extract some sort of value to it, which gives us either a foothold or some kind of toehold onto a further or larger investment that's meaningful to our company. This is just really a quick array of some of the producing assets that we have in the portfolio so far. And you can see with the expected annual cash flow for many of these things, very significant. And some of the producers you can see, Newmont, Yamana on some of these things, and Rio Tinto is some of the other producers. But I think what's even more interesting is to take a look at this development asset slide. Some of these projects that you can pick out. Hackett River, this is a project that we picked up a royalty for a value of equivalent around $4 million. This is a very, very high grade zinc and silver asset located in Nunavut in the hands of Glencore. When Xstrata was operating it, they were very active in developing this. Glencore is not so much. If Glencore or if somebody else decides to develop that, our royalty alone would provide us an estimated cash flow of $9 million. Per year. The Hugo North extension is part of the Oyu-Tolgoi complex. It's not the open pit that they have right now. It's the underground block cave area to the north. Our royalty that we own on this asset, once it gets into production, then there is a timeline for it to get into production, would provide us estimated cash flow of $7 million per year. So these are almost all items that are not currently in that cash flow chart that you saw earlier on in the presentation. So, where do we sit today as a company? We have zero debt. We currently have $20 million in cash available to us. And what that triangle that you're seeing on the bottom represents our cash balances as we see. So that's minus our G&A, minus any kind of tax we may owe on our assets. So the dashed line above that, though, represents the current revolving line of credit that we have available to us, which is undrawn at $110 million. So even today, we have the ability to go out and complete a $130 million transaction if we needed to. The column to your right represents a number of non-core investments that we currently hold as well. We have equity in a number of different companies, and we also have debt investments in a number of different companies. So this is not debt that we hold, it's debt that's owed to us from a number of different companies. This, over the next several years, we will work to liquidate, and that will give us further capital to be able to complete more transactions like we have in the past. For us, there is really kind of a clear pathway. As we start encroaching on $1 billion US market cap, we start appealing to a larger demographic of generalist type of investors. We've got a lot of those pieces in place, and we are getting precariously close to that magical $1 billion mark. We have the liquidity in the stock. We've always had quite good liquidity, but in the last year, as we've been added into a number of these indices, we've started trading at high volumes, up to $18 million US per day in the market. So for us, we feel we're really very well poised as an emerging royalty and streaming company to be able to start trading up towards the multiples that our peers are currently trading at. And for us, that really is the objectives. We want to do similar types of acquisitions as we've done over the last 24 months. We want to focus on those larger anchor assets, but still not forget about the optionality that comes at a very, very low cost in this market. Using our creativity to be able to really develop a full set of assets that's going to help us trade at the proper valuations and similar valuations to our peers. So with that, that's all I want to talk about today. If you have any further questions, I'm available right now, and I'm also available after and before the lunchtime.
David, great presentation.
Thank you.
Someone steps outside here, and I'll just over here on the stage.
Okay.
Are there any questions, ladies and gentlemen?
Yes.
Approximately what percentage of the upgrade that you mentioned came from acquisitions versus new deals? When you talked about juniors to intermediates and seniors.
It's about half and half. So for instance, so 3 years ago, we really got 88% of our production from 4 assets. 2 of those assets were Santa Elena and Black Fox. And so those 2 were subsequently acquired by other assets. Beyond that, a number of other ones like Lakeshore Gold, which we have a royalty on Thunder Creek in the 144, acquired by Tahoe. So a lot of these things have really been updated. I think of all the assets that we have originally done transactions on, really the ones that haven't been acquired at this point are the Aurizona asset, which I think in the future probably has a high chance of getting acquired. Which leaves only really Bachelor Lake, owned by Metanor. And Metanor as well, it probably has the ability, because that's a good high quality asset, potentially it would land in the hands of a larger company as well too.
I'll keep it at that because I'm running late. But David, again,
Okay.
thank you very much.
Thank you very much.
Okay.